When will the government reopen?
Yes, I do. Very talented guy, very smart person.
What about the Fed chair? Who's the Fed chair?
Well, we'll see. They're raising interest rates too fast. That's my opinion, but I certainly have confidence. But I think it'll straighten.
President Trump there keeping up the criticism of the Federal Reserve. But, you know, here's what White House advisor Kevin Hassett told me on Varney earlier.
You know, interest rates potentially, if they went too high, could be harmful to the economy. But you have to understand that people who are moving interest rates around are doing that in response to data. And the data are very, very strong, as the president said. So, you know, I think that looking forward to next year, there are a heck of a lot of upside risks.
Of course, he went on to say that Powell is 100% safe in his job right now. Gary Kaltbaum from Kaltbaum Management President is with us. He's also a Fox News contributor. We also have Hal Lambert with us as well from Point Bridge Capital. Let me start with you, Hal. President Trump obviously has been very vocal in his criticism of the Federal Reserve. Some people, even those who agree with his assessment, thinks he has taken it so far that he's actually boxed in the Fed into making decisions that they otherwise might not have made. What do you think?
Well, I don't think that's, I think that's ridiculous, actually. I don't think that's what's happening at all. President Trump's been talking about this for months. And the Fed is simply not looking at the data correctly. The market is obviously saying something completely different than what the Fed's saying. And what really happened here, Charles, last week was Chairman Powell really messed things up in that interview. And we've talked about this, obviously, you know, data dependent. He said he wasn't going to be data dependent on running off the balance sheet. And that was a big problem. It was on automatic pilot is what he said. The other problem that I'm looking at here is that he's saying that GDP growth forecast next year is 2.3%. Okay, and then he says that that's above the long-term potential of the economy. That is not accurate. That is not the long-run potential. It's much higher than that. The Congress is certainly looking for 3% GDP growth. Certainly President Trump is 3% plus GDP growth, and historically we've been able to do that. So when he's saying that 2.3% is too high, that gives a concern that they're therefore going to raise rates further because they think GDP growth rate is too fast. So Chairman Powell has created a lot of unnecessary fear here, and I think they really need to look at walking back some of these comments. I think one of the things that needs to happen is these Fed governors need to start coming out. We saw it last week. The New York Fed governor came out and said, well, we are going to be data dependent, but they need to come out and more forcefully say, look, we're not on automatic pilot on the balance sheet, and we are data dependent.
Gary?
Look, here's the good news. The Fed's got no more moves left on the upside. The 10 years at 2.7, they're at 2.25, 2.5. They're done. So I don't know what to worry about. And as I've been saying since day one, if we're all worried about a central bank that's at 2.25% and the 10-year at 2.7, that's going to kill markets and that's going to kill the economy, we are in big trouble. Rates are historically are much higher than this. We still have easy money here. We still have ridiculous easy money around the globe. Let's just hope this, whatever bear market, whatever you want to call it, is just that. The good news is there's been many times since the 30s that we've had bear markets and did not have recessions. So the jury's still out, and let's just keep our fingers crossed.
Well, what about the idea that the Fed has been very aggressive of late? I mean, under most circumstances, I hear where you're coming from, but the frequency of which they're raising rates right now and taking out $50 billion in accommodation, which they never did before because they never did quantitative easing before, it's a dangerous strategy that they don't have to take, Gary, if there's no signs of real inflation.
Well, that last rate hike was completely unnecessary, especially with long rates so low, and especially with, man, oh man, look what's going on in the markets. And you had Germany that announced a contraction last quarter. Japan announced a contraction. Our GDP expectations have dropped from the mid to high threes down to the mid twos. You've seen the Philadelphia Fed and the Richmond indexes come in way less than expected. So did durable goods. So we're definitely heading south a little bit here. Doesn't mean the end of the world's coming. And I think that Powell just missed on that. He could have definitely stayed pat. And the other issue is, you know, these people, they never used to be data dependent. But Bernanke was so wrong every month that they decided we're not predicting anything anymore. So we're going to wait till the numbers come in. The problem is when you have Powell start talking about everything's perfect, everything's great, and maybe it's not so great, I think the market was fighting back a little bit of that.
Hal, what do you do with the idea that we're going to grow next year? It may not be as robust as this year. So the idea that we've peaked out, that the economy has peaked, that the consumer is on the verge of peaking, and how do you model that into assumptions for investing?
Well, the valuations have come down, so it's being modeled in by the market. And I think right now we've come down to the point where there are some values in this market. As long as we don't go into recession, this market is really pricing in that we're headed towards recession. And I think he's right. I think the Fed could be done here. The problem is they're not saying they're done. And so that's created a lot of fear. But I think right now you model in that, hey, we're not going into recession. I don't think we will. I think the Fed will come on board here. I think they're going to step up and say, look, we are going to slow things down. We're going to be data dependent. There's people talking about maybe no Fed rate hike next year. And if that's the case, I think this economy can grow.
Gary.
Two very important words, a wealth effect. That right now is in the reverse. And if you're a believer like me, that a decent amount of the last few years was central bank induced wealth effect, asset prices going up, that could be a problem. It could be, something that, feeds on itself. So that's something I'm really, really, really watching closely.
The undoing of the virtuous cycle. Gary, Hal, thank you both very much. Appreciate it. All right, so the markets are bouncing back. Remember, we had the worst Christmas Eve ever. Dave Nelson and Hal Lambert are back with me as well. I'll start with you, Hal. Let's start talking about positioning. Maybe not necessarily for the rest of this session, but at some point, and not picking bottoms, but at some point, people are watching our network and this show for ideas on how to invest and where they should be looking. Somewhere in 2019, there's going to be some kind of bounce, whether you think it's short-lived or not. Where do you think investors should be looking?
Well, as Warren Buffett has said, when people are fearful, you need to be greedy. And I'm seeing a lot of fear out there right now. I've had investors I've talked to. They're actually very fearful right now. So this is probably not a bad time here. I don't think we can call a bottom. I don't know that it is a bottom. But look, I think a year from now, stocks will be higher because I think there's going to be some changes in tone from the Fed. And I think the economy is not going to be as bad as people are projecting. So right now may not be a bad time. But look, people need to look at their asset allocation. If they can't sleep at night based on what's just happened in the last month, then they've got too much in equities. But if you're holding up okay right here and you've got extra cash, I don't think you can time this to the exact bottom, but we've come down a lot. And I think the next few days here are probably pretty decent.
What would be the potential leadership areas? Would it be tech again? Could it be some other area? Because I think people would be surprised to know that this market has done extraordinarily well in the past, and tech wasn't the leader.
Yeah, I think, interestingly, financials could be the leader on this. Because if we can get to the point where people feel comfortable that the Fed is done, I think you could see the long end on the 10-year go higher in interest rates, and then you get a steepening yield curve. That's going to be helpful. We need a steepening yield curve here. We need actually for people to think, hey, there could be a little bit of inflation coming. That's going to be better for the yield curve. That's going to be better for banks. So I think we need financials probably to lead this thing out.
I always say a little bit of inflation ain't too bad. We love when our paychecks inflate. We love when the value of our house inflates. So a little bit ain't too bad. What would you be looking at, Dave?
This is the time of day that I trade. Most of our trades are done at the close of the day. I would focus, there's a lot of names out there that are generating a lot of cash. And one area that I would look at is certainly the airlines. Oil is down 40%. Certainly energy is a big part of the cost dynamic for these companies. So Delta's a name that we own. I'm buying another one today. I love that. I'm buying another one today. I can't mention the name because we are buying it on the close.
It's so funny because Delta just hit an all-time high not long ago, less than 2 months ago. And then it got hammered along with FedEx and UPS really have let the transports down. But that's a unique story. That's more of an Amazon invasion kind of story, I think, and some other accounting issues or whatever it is that's going on.
These are pretty efficient companies at this point. They generate a tremendous amount of cash. They're well run at this point. It's not that these are not the airlines of old. When you have Warren Buffett in, who swore he would never buy an airline, he owns a whole bunch of them.
Well, my whole thing is I used to say airlines used to be the industry we should allow to collude because they were run so poorly. Now there's only 5 of them. So guess what? De facto, they kind of do. But I agree with you. You know what? Pull out some seats, make a guy like me have to spend extra money just to be able to sit down in comfort. It's working. A hell of a business model. Near term, you're kind of worried about this market. Earlier in the show, someone suggested we still have to test the bottom. That whole test the bottom thing, that doesn't go away.
It just has to take time. Time is on our side right now. Look, these stocks have come down a lot. There will be opportunities in the future. Look, unless you think capital markets are gone forever, there's going to be value out there, and we're finding it right now.
Does it bother you, though, how easy this market went down? Once the dam
Yeah.
broke, it just collapsed.
Yeah, it did. And I think the structure of the market is questionable. There's some things out there that have to be done in the structure. We have to do something about computerized trading. We have to bring things back like the uptick rule. It was insane to get rid of that in 2008.
I agree 1,000%. The coincidences, 1987 to now, program trading, algorithms, they're just disastrous. They're absolutely disastrous. Hal, David, you guys were fantastic. Thank you both very much. Appreciate your expertise.